Well, good afternoon, everybody. Wonderful Monday here, and we're ready to get started with another daily COPEC Financial Wellness Webcast. Today we got a really good program. We got a great guest with Jill Spradlin, who is a CPA here locally and does a lot of work with individuals and small businesses. So we're going to talk today, and this is going to be a once a month discussion, which is basically just talking about current events with the tax area and monthly tax discussion. So she'll be able to bring some insight from the CPA side of it. And this is a great opportunity that if you have some questions in this area, that you can talk directly with an experienced CPA who can share their insight with you. So we'll go ahead, and you can see the disclosure up there again, primarily COPEC speaker disclosure, as well as affiliated companies that are on boards and some of the speakers and the companies that are tied to those. And then because I'm heavily involved, we have affiliated with retirement strategies, so some disclosure there as well. Feel free if you have any questions, or you can go to the COPEC website down at the bottom. There's another disclosure area there if you want to look more thoroughly at it. So to get going here, basically, we're going to talk a little bit, and again, there's no cost to do that as well. So today, we're excited about having Jill be part of this discussion. And Jill is here with us. Hopefully she can join us here. There we go. Hey, Jill. Nice to have you with us. Excited to have you here. It's obviously the tax area is a lot of things going on all the time, and excited to have you here with us. Do you have any kind of insights of some of the things going on that we want to talk about today?
Well, unfortunately, I don't have any news on additional stimulus payments or any moves that Congress has made regarding the whole COVID situation, any new moves anyway. So I thought we'd talk about some of the things that have already been enacted and just some of the rate changes and a few other changes that will impact this tax year and next. So there's always plenty to impart, even though they haven't come to any decisions on the COVID stuff.
Yeah, I think for a lot of the listeners, going back a little bit with some of the things that have happened is a great review as well. I like that perspective, because I agree there's a lot of stalemates going on right now as far as any legislatures and changes. So reviewing the current economic climate with past updates. And I just wanted to kind of throw out one thing that I had a question for you is, can you please make sure that you review a concept regarding reviewing personal tax returns, things like that. So if somebody finds out through current legislature that they might be missing something, they might be confused on what they might have, doesn't any individual have up to 3 years to go backwards and review returns to catch maybe things that they may have missed?
You do. Generally speaking, you have 3 years to file an amendment. And I'm glad you brought that up, because they have recently extended some deductions and credits that had expired at the end of 2017. And the 2018 tax law did away with some of those, and they were retroactively reinstated. So there are folks, a couple of examples are maybe the energy credits or mortgage insurance premium deduction as interest, things that were not allowed in the 18 return and have been reinstated, and people may benefit from then going back and amending those.
And just to make sure people understand, if they do their own, obviously they can deal with whatever software provider that they work with. If you work with an accountant like yourself and your firm, is it fair to say that usually those reviews are usually complimentary to help you review to see if something was missing and if there's value to maybe catch those things? Because sometimes the things that are caught are pretty valuable. I mean, it could be 500, 1,000, whatever it might be, that benefit. And just to make sure that you do have those reviewed pretty regularly.
Yeah, and I can't speak for all accountants' policies, but many people will review a client or prospective client's return for changes in tax law, such as we're discussing. And most people, I think, if they're reviewing, will just give the entire review a once over and see if there's anything at all that's been missed. So it's
good. And the key reason why I bring that up is because I've seen this where people think once it's done, it's done. They actually have these provisions, so that as you learn new things, just know that you've got that option on the table to go and have those taken a look at and seeing if there's something that was missed based on what you might learn in some of these.
And we're frequently asked also, is that audit bait? Will that cause my returns in the future to be looked at? The answer is no. The IRS processes millions of amendments every year. That does not single you out in any way to file an amendment. So
okay, that's good to know.
I would never hesitate to file one based on fears like that it's going to target you for an audit. That's just not true.
I guess you never really know for sure, do we?
They don't have the capacity.
Yeah, I bet. Well, great. Well, you mentioned there kind of like, I think you mentioned rebates there, but what kind of things have been going on as far as rebates, stimulus, things out there that everybody needs to be aware of and how it might apply to their taxes?
Well, the first thing to point out, because there's some confusion about this, the rebates, the prior economic payments were based upon an estimate based upon either your 2018 or 2019 last filed tax return, but they will ultimately be calculated on your 2020 return. So if you filed for instance, if your income were too much to receive an economic stimulus payment based on your 2019, but when you go to file for 2020, if your income was maybe reduced and you are eligible, you will receive that payment then. So these will be reconciled on your 2020 tax return.
Okay.
Another example is if you had a child who was a dependent in their 2019 return, 20 files for their own, they will receive an economic stimulus payment when they file. Right now, the current thinking is if, for instance, a parent got a stimulus payment for a child as a dependent, and then when 2020, it turns out the child claims themselves, the parent won't owe the $500 additional payment back that they received. So it's pretty much a one-way. If it's positive for you, the change, then you will receive the stimulus payment. And if you received one or too much based on legitimate figures from 18 or 19, you will not have to owe that back with your 2020. So that's the policy.
And are there any other, types that fall under that rebate stimulus that has been going on, or is that pretty much the primary?
Income changes are usually what affects it. If people received an erroneous payment for a taxpayer who was already deceased, they were directed to return that. So if a couple, for instance, received two $1,200 stimulus payments and one of them had already passed away, they're supposed to return that stimulus payment. Other than that, it would be income changes to someone's income or their dependency status that would make a difference. Another maybe example would be a baby born in 2020 as another dependent. When they go to file that tax return, there would be another $500 stimulus payment available to them for that additional dependent.
Okay. Well, I know, and we've had some discussion on this as well, but, there's been two legislative acts that have been passed over this past year. One of them was pre-COVID, if you will, and the other was post-COVID. So let's maybe go back to the pre-COVID. They didn't know this was going to happen. So this is just something that was passed prior to any knowledge of this disease being out there. And that was called the Secure Act, right? And can you kind of go into that a little bit as far as how it applies? Because that's started, correct correct me if I'm wrong, it started January 1st of this year.
Correct. One of the major things the Secure Act did was to raise the required minimum distribution age for the first distribution you have to take from an IRA to 72 from age 70 and a half. This only affects people who had not turned 72 yet. So it would be newly eligible recipients. And the act allows the delay of the annual required distribution to a slightly older age, so that's beneficial. We could probably do a whole in detail, and maybe should do a program on the Secure Act provisions, because there were quite a few things affecting retirement accounts and such that I wouldn't have time to probably go into in real depth here, but know that there are a number of things that were affected, and all of those would be, well, not all of them, but most of them have to do with retirement accounts. I think that's fair to say. The CARES Act, that's the one that came along with the coronavirus provisions. And something important there is that it allows people to skip the required minimum distribution for 2020 without any penalty. The penalty for not making a required minimum distribution is very severe. Usually it's 50% of the required distribution. So it's a very, really severe penalty for not doing that. That's permitted not to happen this year, to help people out if they're able to keep more cash in their account and not to force them to withdraw money while perhaps the value is a little depressed. So another thing that the CARES Act did was a 10% penalty waiver if you need to take an early distribution from an account, if it's coronavirus related, such as you were diagnosed or a family member, or you were laid off or had significantly less work because of the coronavirus. You can take up to $100,000 distribution out of a retirement account without a 10% early penalty payment. It would still be taxable, subject to your income tax rate, but not have the 10% early penalty. So.
Okay. Anything else in that area that's kind of noteworthy?
Not so much reflecting the retirement accounts. The CARES Act had some other provisions. Some of them affect 2020 filings, such as a $300 above the line charitable deduction that will be available. We discussed a little bit that there will be reinstatement of some energy credits and deductions such as mortgage insurance premiums that will be available that had, and this was the Tax Act of 2018 that had eliminated those. There are still some other things under discussion as well. Again, I wish I had a little more definitive to tell you, but they are discussing possible full deduction of business meals, you know, the mileage, the per mileage amount, employee business deductions, all of those kinds of things are always under discussion because they are, to a certain extent, stimuli to the economy, and they help keep more cash in taxpayers' pockets, which is the point of most of this relief, so that people can continue, consumers can continue to spend and to be able to get what they need. Some of the provisions regarding real estate may impact. Again, that's probably a program in and of itself, just some of the changes, and should, you know, maybe a little bit further down the road we'll have the final word on some of those things that are going to happen. The tax brackets, the standard deductions go up a little bit for this year. $12,400 for single people, $24,800, double that for married filing joint returns, and $18,650 for head of household filers. The over 65 additional amount is going to be $1,650 this year. The tax brackets accordingly adjusted upward a bit. So the 12% tax bracket The upper level for single filers will be $40,125 of taxable income. So that's after your standard deduction or your itemized deductions. It's $80,250 for married filing jointly, and it is $53,700 for head of household. And at that 12% bracket, if you do have capital gains, long-term capital gains to report, they will be taxed at a 0% rate. So there will be no capital gains tax under those income levels. The 22%, the next bracket up, tops out at $85,525 for single filers, $171,050 for married filing jointly, and $85,500 for head of household filers. So people in that bracket and above, up to a much higher threshold of about $400,000 in income, pay a 15% rate on capital gains. So those are the brackets we're looking at for 2020. As I mentioned, there will be a $300 above the line charitable deduction allowed next year. And that means that even if you're not itemizing personal deductions, you may take that charitable deduction.
So over 2019, the changes in the brackets, the 300 over the line, changes in, the brackets, standard deduction numbers. What other major changes have happened from last year over to this year?
From 19 to 20, right now, there are not a lot of very major changes. The big changes came in 2018, and then the big thing that's happened since then have been the CARES Act, and then also the restoration of some of the deductions that the 2018 law had removed. Right now,
I'm sorry.
Right now, all the current law is still subject to a sunset provision in 2025. So the entire new law that was enacted in 2018 applies through 2025. And then if Congress does not take further action, everything would revert to the 2017 tax law. So that's another question mark in tax planning right now, is whether and what that will be replaced with.
What about any changes from this year going into next year?
Going into 21?
Right.
Well, there will be the usual adjustments for inflation. As far as I know, there's nothing major on the horizon right now. Both the presidential candidates have posted tax platforms of things they'd like to do, but all of that has to be approved by Congress. So they can kind of say lots of things in their campaign. That doesn't necessarily mean they have much of a chance of getting enacted. So I don't know that I would do a lot of planning based on.
But nothing's already in place that would be fulfilled next year, apply next year, that isn't already involved.
Right now, things are pretty similar from one year to the next. There has been a change in the W-4. So all employees that haven't filled out a W-4 form this year for their employer probably want to fill out a new one and make sure they get that done. In addition, the tax form itself, a draft of the 2021 form has been released, that will be filed in 2021 for 2020. And there are, a few tweaks to that. So it's going to look a bit different from the 2019 form. It seems like every year now they make some changes so things are not on the same line, or some things may move from a subschedule to the main 1040 form itself or move back. But in terms of major changes between 2020 and 2021, so far there haven't been any.
Obviously, through the CARES Act, there were things like the PPP loans. We'll put that aside. There's unemployment. We'll put that aside for a second. Maybe you might want to make some comments on that. But the other is, and none of this has to do with politics or anything like that, but there was some executive orders on the deferral, I understand, of the payroll taxes. Can you explain that to people as far as what that means, regardless of whether it's good or bad, but just what does it mean tax-wise, and how does that affect an individual?
Okay, so for employers, they already had a provision where half of the employer share of employer taxes for Social Security and Medicare, half of that could be deferred to be paid in 2021 and half in 2022. So that is on the employer side of things. Affecting the employee, the executive order said that the employee's share could also be deferred to be paid by next, I believe it's April 15th. So rather than being withheld, and this is at the employee's option, they can have their employer not withhold the employee's share of the Social Security and Medicare. That would come to 7.65% of their pay. They could opt to have that deferred and then pay that. They would pay that through their income tax return filing by April 15th. The employee would. So that is the employee's option, I believe, to request the employer to do that. And we would caution our clients that it's not a forgiveness of the tax. It is currently just a deferral. So you would have to then satisfy that requirement next year. So that's the status of that currently.
Okay, good. Thank you. We're pretty close to finishing up here, Jill. I think we did a pretty good review of what's going on out there. If there's any questions, please go ahead and submit those. I don't see any at this point, but do you have anything you want to kind of wrap this up with as far as to leave people with, as far as making sure they're staying on top of everything?
Yeah, I would just say that a couple things. We probably will be doing a couple shows a little bit later that go into more detail. Of course, if they enact something, I'm sure we'll try to get on the schedule right away to get people up to date with new things that get passed. And then the other thing I would just caution people who are self-employed, either have some self-employment or side income or a change to their income or any other significant change to their situation, to maybe meet with their accountant or at least discuss some things with them between now and the end of November in case there are any needs, if there are any moves they need to make for 2020, or if there's any planning opportunity between 2020 and 2021, that's the window of time to take care of those. So more so than most years, people probably ought to review their situations and decide if they need to talk to somebody sooner rather than later.
Yeah, and I just can't agree more as far as if you've got enough life events that have happened to you, or with everything that's been going on, or if you do your own, just have them looked at, because again, we find over the years that missed opportunities is the biggest issue to make sure things are applied properly. And there's so many rules out there that can happen pretty easy. So appreciate your joining us today with such a great insight with what's been going on with the IRS side of everything. So thank you so much for joining us, Jill. I know that you will be joining us, I think, every other week, if I recall. And thank you so much, and appreciate you joining us.
Okay, thanks a lot, Jay.
Thanks, Jill, and thanks everybody for joining us today. There are no questions, so we'll go ahead and just call it here, and we'll see everybody tomorrow, and Jill, we'll see you in a couple weeks.
See you soon.
Thank you.